okay, so starting with 26, we're gonna go through the stuff very, very quickly because I want to focus on the actual examples of these things. So, first things first, valuation, gonna based on a variety of different things. So, variables that relate to future returns, comparables, or you can do it from a liquidation value or net asset value perspective. Okay, so why does it happen? There's a mispricing that happens. So the market price might be 100, and let's say the intrinsic value is 120, then you know that you can actually buy it and make a return. Okay, so abnormal return is if you make alpha, so more than what the market is expecting. And how do you do that? You either sell something that's got a lower intrinsic value than the market value, or you buy something that's got a high intrinsic value than the market value. Okay, you guys can go through that. That's quite easy. Just the concepts, going concern, the thing's got a better value as a business than it is to just sell everything. Liquidation value or orderly liquidation value, that's more of a function that if you sell the underlying asset, it's worth more than the thing running as a business. There's actually quite a few businesses on the JSE, it's got massive discounts to NAVs that you could just liquidate and get more value from it. Okay, so you don't always want to use a going concern valuation. Fair value, fair market value, investment value, etc. Guys, these are just theoretical concepts. Fair market value in this case, they just mean what's it trading on the market or on the JSE. Intrinsic value, this is a theoretical concept that if you've got perfect knowledge of the assets, perfect knowledge. Okay, nobody has got perfect knowledge, not even the CEO of the company. If you have perfect knowledge, that is what it should be trading at. Okay, the estimated value is what all the analysts and the portfolio managers estimate the intrinsic value to be. Okay, so when anyone tells you this is the intrinsic value of the company, what they actually mean is this is what I estimate the intrinsic value of the company to be. Okay. Investment value. So investment value, that's another one. Investment value is that there might be a strategic buyer. So for a specific firm, because they have synergies, it might be a little bit higher than what the normal intrinsic value of the company is, because they can extract more value than the current owners. Okay, the reasons why you would want to do this stuff, guys, this is quite basic. I'm not going to go through this stuff too much. If there's anything that you see that you want to talk about, speak now. Or okay, that's fine. Then the important stuff about this is the Porter 5 forces. So Michael Porter, guy from Harvard, strategy professor, he identified these 5 forces, and depending if the forces are high or low, that will determine whether that company's got that specific sector or company will have more or less profitability. Okay, so what are they? If there's a lot of intra-industry rivalry, then it's going to be low. It means lower profitability for the guy. So think about it. If there's intense competition, then obviously prices might go down, and they're just fighting for market share. That's not a good thing. If it's got a massive high barrier to entry, like it's very difficult to get either the license or the patent or the brand or whatever it is, then it's very good. So if it's a high barrier to entry or high barrier to new entrants, that's a good thing. The negative thing is if it's got high barrier to exit. Think about that for a second. If it's got too much, if it costs you a crap load of money to exit the business or the industry, then obviously what's going to happen is you're just going to keep on and on and on because you can't close this thing down. It's going to cost you too much. That's a very, very negative, especially if there's overcapacity in that industry. Okay, substitutions. I mean, every economics book that I've ever read, it always uses protein as a substitution thing, like chicken or pork or whatever. But the substitution thing, if it's very easy to switch, that's a very negative thing. It's very difficult to switch. It's a very positive thing for the company. So let me give an example. Once you are so in finance, if you use a specific terminal, whether it is Bloomberg or Reuters or whatever, all your models and all your risk stuff is built on that specific terminal or that specific data provider. The cost for you to switch is extremely high. It's the same thing for SAP. If your organization has implemented SAP is going to stay with that organization for a very long time. It's too difficult to switch. So that's an example of the substitute thing. Then supplier power and buyer power, you guys kind of know that. So supplier, if you've got hundreds of suppliers, and one guy doesn't make up the majority of your cost of sales, your cost of sales, the stuff that you purchase, that's fine. But if one guy is 90% of your supply of something, that company can probably determine what they want for the product. Good example of that is Microsoft. I mean, they've got pricing power because they're the only guy. And then buying power, if you're the biggest customer for this company, you can you can basically determine the price that you want to pay. Okay, and then 3 strategies. You guys can go through that. Either you're the cheapest, or you're the most desirable, or you focus on a specific thing that people want. So let's look at phones. Or I actually always use pens. So cost leadership, you buy a big pen. Differentiation, you buy a Mont Blanc pen because you want to show it to people that you've made it. And focus is maybe something very specific within that. I mean, I think phones are probably easy. So focus might be that this phone has got the best camera or whatever. Yeah. Okay. You guys can read through that. And then contrast absolute versus relative models. Absolute value gives you once you've determined the valuation, or if you've done the DCF, it'll give you an absolute number. Like it'll give you like 16.57. Okay, that's an absolute valuation model. So that's either a DCF or an asset-based valuation. So that'll be your NAV stuff. Okay, net asset value thing. When it comes to relative value, it gives you a range of stuff. So if you do a relative valuation of a company, use maybe 5 different multiples, PE, price to book, EV to EBITDA, whatever you want to use. And then according to that, it'll give you a range of this company should be trading between these ranges of the equity value of the enterprise value. Okay, that's your relative valuations. Okay. Then valuation of total entity and its components. That's your sum of the parts. Example of that, Bright, you look at the underlying investments that they hold, and you value each one on its own. You add everything together, you add or subtract, either you add the cash or you subtract the debt, and then you divide it by the number of shares, and then you get a value for the company. Okay, that's sum of the parts valuation. Okay, people do that for Naspers as well because they've got underlying investments in that thing. And then conglomerate discount, there's usually a discount to NAV for these things. So Bright is trading at a, if you believe their valuation, probably like a 55% or 50-something% discount to NAV. There's a variety of the things. Bright, Brimstone, Astoria, Zeder, all these things are trading at discounts to the net asset values, even Naspers. And there's a variety of reasons why to do that. Either the capital is inefficient inside there, there's other factors. You guys can read through this. Okay, issue in model selection and interpretation. You have to select a specific model for each company. It doesn't make sense to choose a dividend discount model for a company that doesn't pay dividends. That's an example. If it's a VC fund, you can't use a cash flow model necessarily because, or a venture capital type of company, you can't use a cash flow methodology because the thing's burning cash. It's not generating cash. Okay, so there's different ways that you need to determine that type of stuff. Okay, that's fine. Is that it? Oh, that was quick. Okay, that was 26. 27. Okay, let's do 27 quickly. So, distinguish among realized holding period returns, expected holding period returns, required, blah, 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 blah. Okay, holding period return, that's the time that you hold it for. So, it's not specific for a time period or anything. So, price you sell it at minus price you buy it at divided by the price you pay it at. If there was cash flows in between, you either add or subtract that. So that's very, very basic. That is this formula here. Okay, so important there is if you receive dividends in the process. Okay, expected holding period return, that's what you expect to achieve from holding that asset. And obviously your expected holding period return should be higher than your required rate of return, otherwise you wouldn't have thought that it was undervalued. Okay, required rate of return is what you need as a minimum, and this is basically what I said. If the expected return of the asset exceeds required rate of return, then we say the asset is undervalued. Not gonna, if you think something's going to return you 20% and you just need 10%, then you're going to buy it. Okay, and vice versa. So, expected return estimates for intrinsic value estimates. Okay, that's just basically you're going to work out the intrinsic value of the thing. Discount rate, you're going to use that for your discounting cash flow. So that's going to be your if you're discounting dividends, it's going to be your cost of equity. If you're discounting cash flows from the entire company, it's going to be your weighted average cost of capital. And then IRR, this is a quick way to solve IRR for a company. So it's your dividend yield, next year's dividend, plus your expected dividend growth. It's not always accurate because you need a specific company that's more mature to calculate this. But the nice thing about this, it gives you an idea of what you should be getting as an investor in a dividend share. Okay. And that's easy enough. Okay. Then equity risk premium, you can have historical estimates, forward looking, and those are the various stuff. The nice thing is you've got this nice model here, which I'm going to touch on quickly. So this is if you use the Gordon growth model. So what is that? It's your, remember, your equity risk premium is what you generate above, what the market is expected to generate above your risk-free rate. Okay, so your dividend yield plus the growth in your dividend minus your risk-free rate. Okay, that's the easy one. That's not too difficult. But this one is a bit more tricky. I'm going to explain to you what it is and how to interpret that. It's basically almost, it's very similar to what we've got here. So it is 1 plus your inflation rate, because inflation impacts your earnings of a company and so on. So it's your nominal rate, times 1 plus your expected growth in real rate. So now, obviously, you've already done the thing to turn it into nominal, so now you're just going to use real rates going forward for the other stuff. So the first one is your expected return on your growth in your earnings. Okay, so let's say the entire index, you expect the earnings growth to be 10%. Okay. Then you multiply that by what you expect the PE ratios to adjust with. Okay, you've got an index, let's say index is trading at a 16 times forward PE, and you expect that thing to increase to 17 times. So that'll be an impact of that as well. You deduct your 1, which is essentially just to turn it into a percentage, and then what you do is you add your yield. So what the dividend yield of that thing is going to be, and then lastly you deduct the same as this thing here, your risk-free rate, expected risk-free rate. That's just one other way. So if you think about it logically, this entire thing here is essentially what you expect is going to happen with the index. Okay, so you've got your expected return on the growth on the earnings wise. You've got your PE adjustment, and you've also got your inflation, which is obviously going to push the stuff up anyway. And then you've got your dividend yield as well. So that's your total return for the index. It takes in all the components: your earnings, your pricing of the PE, where it's going to be higher or lower, as well as your dividends. Okay, so that is, and then obviously it takes inflation because you took the real. If you just put this and you didn't say real, you just said nominal, then you can leave out the interest rate, obviously. Okay, but guys, it's very basic what the thing is going to achieve. Just think about what drives index return. It's earnings growth. If the PE doesn't change, then it's just going to be the earnings growth and the dividends, the nominal earnings growth and the dividend that you're going to get. Okay, that's going to drive the index. If the PE goes up, so there's an expansion of multiple, then obviously that's going to shift up the value of the index. Okay, is there any questions on this? Okay, so nominal is real times real and inflation together. So 1 plus real times 1 plus inflation. So if this thing here, if it wasn't real, it was nominal, then that all that you're doing in this thing is you're doing it from, you're converting from real to nominal. Okay. Sorry, it's like that's the risk-free rate there. Expected risk-free rate. Okay. Sorry, then I mixed up the terminology. Okay. Then this is the stuff we went through quickly, the CAPE model, capital asset pricing model, and we trying to get the equilibrium rate from that. So main thing about that is what you're expecting that the market is going to return to you. Okay, because if the market's got a beta of 1, then that's just the risk-free rate plus the market risk premium. Arbitrage pricing theory is basically what you're doing is you're going to look at specific factors that are going to reward or not reward you. When I say I have a negative reward. Okay, so what that means is that you're going to add risk, like betas and risk premiums. What does that mean? If you look at the capital asset pricing model, the beta is the market, that's basically your market risk premium. Either going to add or subtract. When I say add or subtract, you're going to have a positive beta for the market's 1, but there are stocks that might have a negative beta. Okay, then what this arbitrage pricing theory does, it adds a bunch of factors, whether it's a size factor for a company, whether it's a size, the market cap, might be a liquidity factor, might be a momentum factor, can be a variety, it might even be an oil factor. for that matter. Like if you think about MTN and Sasol, both those companies have massive oil factors when it comes to their share price. Because, well, MTN more because of Nigeria and how that foreign exchange is earned in Nigeria. But just think about that. That oil definitely has a factor component in this type of thing for MTN. Sasol is self-explanatory, but you guys understand what I mean by that. So Farmer French it is an APT model, but it's a better known one. And what it is, it looks at that's kind of what I said, that it looks at the size. So it looks at the market one, it looks at the size, and it looks at the value factor. So those three. Okay. So the market is the one that's in CAPM. Size is the market cap. And what they tend to find is that if it's a smaller cap company, your beta is higher, so you tend to be rewarded, so you get more money from, or you have a higher risk premium, you can be rewarded more for that. And the value factor, value stocks tend to outperform growth stocks, but remember this is over a very, very long term. It's not, there are portions of the time that this doesn't work. Okay, and then this one, all that it added was the liquidity factor. Okay. So I went through that. And then the macroeconomic factors are quite nice because if you get that, just know what goes in there, but it's just a plug and play. So I'll give you the betas and I'll give you it'll give you all the information basically. Just literally just plug and play and then you work it out. Okay. Build-up method is more of a, like if it's a very illiquid stock, then what you would do is you would say, okay, the risk-free rate and the equity risk premium is whatever, and then you just add and subtract various factors. Like, okay, I'm going to invest in Nigeria. So let's start with South Africa's. Well, we'll do Nigeria's risk-free rate and equity risk premium, but I'm going to invest in this sector that's very rife with corruption. So I'm going to add a corruption premium. I'm going to add a country premium. I'm going to add this premium. So that's how you do a build-up method, and it's not very, very scientific. Okay, minority interest, obviously, if you're going to get a controlling stake, then you need to pay more for it. And lack of marketability, that just essentially means that your discount rate's going up because you can't sell it to anybody. Okay. And then bond yield plus risk premium, a way that I can explain this is that if a company is, well, not just a company, let's say you're looking at what the yield is of an American utility company, and that is the yield, and then you say, okay, I want to go to a specific emerging market, and then what you might add there is you might add you look at what the bond yield is of that, so let's say Eskom, that's the bond yield, so how much it is higher than the one in the States, and you would add that to your premium. Okay, you get these things called CDSs, which create default swaps, and that's the stuff that you tend to add. So you can actually get this information on Bloomberg or any of the other data providers. Okay, that's fine. That's the bond yield, so you guys can go through that. And then beta estimates for listed companies. Guys, you can run this stuff once again on these systems, Bloomberg and so on. There's actually a website run by Dromedaran. I don't know if you guys know him. He's a professor at NYU Stern, and he's like a corporate finance specialist. And you just go onto his website, and he's got all the betas, unlevered betas and stuff for all the indices in the States. And so that's what a lot of the corporate finance guys tend to use. Okay, so the beta estimates for publicly listed companies. Adjusted beta, just basically you adjust for beta drift. Guys, it's a super easy formula. All that you do, you say 2 divided by 3 times the actual beta plus a third times 1. Okay, that's just, I don't know why they do that, but actually Bloomberg came up with this thing. So the Bloomberg guys. This is the Bloomberg model actually. And that's beta drift because they say it drifts towards 1 over time. Okay. And then thinly traded stocks. So you guys are going to go through this in corporate finance. I don't want to steal Paul's thunder. But what you're going to do, you're going to look at a company's beta. So let's say you've got an unlisted company and you want to impute a beta on it. What you're going to do, you're going to run betas on a bunch of listed companies, what the actual beta is. Then you're going to unlever those betas because those are levered betas. I'll explain that now. Unlever that, all of them, average them, and then relever on your own company thing. So what does that mean? It means that your beta differs depending on your capital structure due to the fact that the more debt you have, the higher your beta, your levered beta will be. And if it's unlevered, then it's 100% equity finance company, no debt, and then obviously the betas will tend to be closer to what the true beta is. So it takes out the capital structure decisions for those companies, and it puts on the beta then for the company that you're trying to work out the beta from. So let's just go through this. Identify a publicly traded benchmark company or companies that have similar operations to our company. Estimate the beta for that company. You do a regression analysis, so you can just press 2 buttons on Bloomberg and does it for you. Unlever the beta on the publicly traded benchmark company and then relever that beta on your company's capital structure. And the formula is as follows. So unlever it, beta of the public company times 1 divided by 1 plus the debt of the public company divided by the equity of the public company. So that takes into account, that basically takes a decision of the capital structure for that public company and it neutralizes it. And then when you relever it on your company, then you're going to do that. You're going to say unlevered beta of the public company times 1 plus the debt of your company divided by the equity of your company. Okay. Once you've done that, then you've got the real levered beta for your company. Okay, guys, people use this all the time in corporate finance, so that's why I don't want to spend too much time on this thing, because that's Paul's thunder. Okay, then the CAPM, multi-factor, and build-up. Guys, everybody uses the CAPM model. Why do they use it? Not because it's super accurate, because it's the easiest thing to use. Okay, that's why it's almost like that thing where they say the guy's looking for his keys, the street lights here, and he's looking for his keys here, and someone comes and says, what are you doing? I said, no, I lost my keys. And say, where did you lose it? I said, no, I lost it over there. Said, well, why are you not looking over there? No, but lights over here. Okay, that's a CAPM model for you. Okay, but anyway, that's a okay, but just know that that's the point. That's the point. Everyone uses it, and it's got low explanatory power. That's what I meant. Okay. Multi-factor models, way more complicated, a lot more quants and stuff that you need to run. And remember, the correlations change all the time. Okay, so more complex, expensive, and so on, but it's got a high explanatory power versus the other. And then the last one, the build-up method, is like the simplest one to use, but also said it uses historical value. Okay. No. I use a rough one like that. So I use this kind of thing at like 15-20% and it's done. Guys, if you work out all these things, like I just want to say this quickly. Let me pause quickly. Okay, let's move on. Okay, you guys can go through that. And then for international required returns, use a country spread. That's kind of the thing what I said about if you look at the US, equity risk premiums tend to be similar, not entirely, but close enough. So if you think about the US equity risk premium, that tends to be anything between 4 to 6%. South Africa tends to be the same thing, but the one thing that is very different in South Africa versus international, the US, is that the US 10-year bond rate is what, like 2.4, 2.3, whatever it is now. It's gone down a little bit. And the South African R186 is like 8.45, and that's not even 10 years out. But the point I'm trying to make is it's much higher in South Africa due to the fact that your risk-free rate of the government bond is, your sovereign is much higher. That's why your cost of equity in South Africa in rands, not in dollars, in rands, will be higher than obviously what you're going to get in the US. Okay. This is actually, do you have this whole model like this? This is actually called the Goldman Sachs model. They've actually got they developed this thing. Okay, sovereign bond yields, and you'll get that from the CDSs as well. So how much more risky is a South African sovereign versus an American or treasury or bond? And that CDS will give you a very good idea because that's how much risk additional to that is in USD. That's quite important. That's fine. And then weighted average cost of capital. So guys, we have gone through this in the break. Weighted average cost of capital, you take the various sources of funding, whether it be equity, debt, or preference shares, or whatever it is, you weight it according to how much the proportion that is, and then obviously you multiply it by the relevant cost of whatever that is. So the important thing about that, cost of equity, you use the CAPM, preference shares, they will give it to you, 11% whatever. There's no tax deduction for preference shares for you as an entity, so there's no tax shield. For debt, you take the coupon, or not the coupon, the interest, effective interest, times 1 minus the tax rate, because you have a tax shield for that. That's why people like debt, because you have that tax shield. And there's your wonderful formula. And remember, you're using the market value of both. Market value of debt and market value of equity. Divide by, I mean, that's just the combination of the two. Okay. That is extremely important. That's 1 minus the tax rate. Because that is where that's where the secret sauce lies for you as a company. Okay. And then lastly, when you look at the various cash flows that you can generate, you've got free cash flow to the firm or cash flows from the firm. Remember, the firm is made up of, I always draw these things where, okay, so those are the assets. Let's just say the cash is 0 for now, okay, and the payables is 0, because I don't want to get it too complicated. So that's your equity plus your debt. This side of the balance sheet is your funding side. That's what funds the operations of the company, the plant and all the other crap. Now, important thing about this is that when you are talking about the cash flow to the firm or free cash flow to the firm, you're talking about the cash flow to this entire stack. So it's your debt providers, whether if it's preference shares, it'll be your preference shares providers, and it'll be your equity guys. Okay, those three. So it's debt, equity, and preference. So all the guys that are funding your company. Okay, remember funders, the banks, preference share guys, and your equity guys. Okay, that's to the firm. When you're talking about cash flows to debt holders, it is this portion here. I'm assuming those are the equity and that's the debt. Okay, it'll be for that portion. And if you're talking about cash flow to the equity holders, you're talking about what's left there. So how does that work? Once you've generated cash flow for the firm, so free cash flow to the firm, then what you do is you say, okay, generated, the company has spent the money to maintain the capex, etc., etc. Now what's left, I can distribute to the funders. Obviously, the banks want their interest and all the other crap, but I can choose now to either not pay the principal and I can distribute it to the equity guys, whatever. The point is, once these guys have been paid or serviced, then what's left is going to be for the equity guys. If obviously there's no preference guys in that case. Okay, does that make sense? That's why if it's for the entire firm, you use weighted average cost of capital. If it's for debt, the cost of debt, and for this you're going to use cost of equity. Okay, guys, I'm gonna stop the recording now and just